We would be wrong on our intermediate call here. And the long-term trend is positive. I don't think we're going back to sit on the 50-year range. And again, I probably said this before in chatting with you, is that if you go back and look, let's take three other metals, for example. Copper. Copper lived in a multi-decade range between 50 cents and $1.50. And you could just draw a little range-bound situation until late 2005. Copper then nudged up through the top of that range, and within about 3 quarters or so, went up to $4.10. Remember, you had a range from 50 to $1.50, let's call it average of $1, multi-decades, confined, broke out, went to 410, and did it in quarters, not a couple years. Okay. And after that, lived in a new range that you could probably average at about 3 to 350. Of course, now we're trading 630. Okay. Go to lead. It was confined in a multi-decade range, same as silver, 1970s, 80s, 90s, until 2010. And then lead decided, hey, I'm going to break out of this range. It wasn't in sync with copper. Copper had done it in 2005 and 6. Lead did it in 2007, a year later. And quadrupled in price in a matter of several quarters, which went to a new reality, but didn't take years to get there. And then lived in a new reality at a much higher level. Okay, gold, the mama metal, the mama monetary metal. Silver's the, poor man's gold, okay? Silver always moves with gold, major trend swings, always. But how come when gold kept making new highs, 1980, 2011, 2020, took out the 2011 highs, lived up there. Silver was still capped at 50. Copper wasn't capped. Lead wasn't capped. Gold wasn't capped. How come silver was confined in this little box? Well, there's arguments that, and evidence that it was restrained by certain arbitrary forces from the outside, trying to keep it capped. Well, they failed. And whenever a market makes a mistake, like staying way too high for too long, or way too low for too long, when it compensates for it, it often goes berserk, which it doesn't do it in a logical way. It does it in what you think is an irrational way. It just unleashes to correct itself. I think silver's in that process. And I think, if we measure from what we consider to be when the clock began for this multi-quarter surge, let's say, was November's close. That's when silver broke out versus gold, like a 10-year wide range of very low valuations, and broke out of it, and still above it, by the way. Silver's still doing better than gold. It's only, that was November close, so we start December, Jan, Feb, March, April. We're a couple quarters into it. We're arguing that in the next quarter or so, when you come out of this congestion zone, you could see the absolute parabolic move that copper produced, that lead produced, and their move to new reality. And it's up to the bears now. You either prove your case or you fail, and you got to do it like right away, like now. Those kind of averages are often noise. If gold, for example, had come down to its 200-day average in the past couple years and held it and rallied, dropped to it, held it and rallied, then when we plot a momentum chart of gold versus its 200-day average, you would have seen 2 drops down to the zero line, meaning where the average is, been above the average, or is it going to go below it? It would have held it and held it. It would have created what we call a structure, meaning a floor at the zero line, at the 200-day, We didn't do that. We just broke below it without any prior references, multi-point lows at the same average, that created a structure. So it is a non-structural break of a moving average. It's not meaningful. Now, sometimes a market will set a structure at a given moving average and turn it into what we call meaningful structure. This is not. It's merely weaving a number that every guy out there knows and thinks, oh, it's the end of the world. So anyway, that's our assessment of that. The 200-day is noise. And it's good that it broke it, because that then put into the bear side anybody who was using that as their metric of, is it still bullish or not? So they're now bearish as well. Fine. Everybody's bearish almost. I don't know if it's 90% or what, but it's some high number, put it that way. That one thing they need to be aware of, and this is true in any market, okay, point of entry is very important. If you got long silver because it broke out of a silly price range, a 50-year range, and only then did you get long, $55 or 60 or 80 or whatever, then you're suffering. You're break even at best, or, especially if you bought it in the 60s or something. And if you bought it at 100, you're really hurting. Okay? That's because you entered at a bad time. Our buy signals based on momentum factors just over the last couple of years. We're at $25 plus in 2024. March of 24, we put out a major signal saying we're going to go up and take out that $30 high that occurred in 2020. Okay, just mark that down. 25 to 26 zone was a buy. Next level was 35, June of 2025. And our final long-term buy signal was at $56 when silver's close in November last year broke out above gold's relative valuation chart, where silver had been confined. It broke through the top of that range. So if you got in at those entry points, your average price is in the 30s somewhere. So yes, you've given back profits, but you're not losing. And frankly, if you look at the bull trend since the 2015 low, especially in gold, I mean, there were plenty of times you had major pullbacks, and yet they weren't the end of the bull market. And you're glad at that point in time when you saw those pullbacks, some of which we did call, that you got in at a good price. So right now, the issue is we got too many people sucked into the market based on simple price chart stuff, breaking through the $50 range and gushing, and therefore waking people up about the new reality in silver. They're getting hurt, I admit. Question is, are we going back to 50? And I'll give them about 24 to 48 hours to prove the case. Yeah, most of the congestion zones we've seen in what has been a layered bull market in silver and gold for the last, handful of years, even 11 years since the 2015 low. Anytime we get a range-bound situation and you break out of it, especially in gold, and you surge, everybody always analyzes, quote unquote, that it's got to go back and sit on the old resistance, the old highs of that range, and then turn up again. And it never does that. It builds a range, breaks out of it, but it never seems to go back to the top end of the prior idiot range. And a lot of people are now talking $3,500 gold to get back on top of the prior range. Okay. Well, all I can say is the clock is ticking and 3 strikes and you're out. You better make this one work. You better hit a home run on the downside, because otherwise the bull forces are going to take over and you're going to come out of this congestion zone. And we argue that as you come out of this congestion zone, assuming we're right in this analysis, it will be rapid. It won't take 3 months to get back up to the highs. It might take 3 weeks or something. So the issue right now is bears are in charge. Let's see it. And their clock is ticking. No, we measure the monetary metals in all markets on a long-term momentum trend basis. That doesn't mean looking at a price chart. We measure them versus a 3-year average, 30 and 3/4 average, and we plot an oscillator. We don't just overlay the silly average, because sometimes that doesn't mean anything. But when we plot the chart, a momentum chart, this recent break that we had literally was a 1.5 day phenomenon. January 31st, February 3rd, and gold and silver. Since then, that break did not damage any long-term momentum trend factors, period. Okay. Therefore, we have to define this break, however sharp it was, from a day and a half drop, from 120 phantom high, really, because you were only up there for hours or a few days between 100 and 120, down to 64, okay, February 3rd. And since then, you've gone up and down and up and down. It's been 6 months now, Jan, Feb, March, April, May, June. Okay, we're in this 6 month of selling pressure. And where are we? We're trading where we were on February 3rd. $64. Now, there was also a run the stops type of low that occurred on March 23rd, where the silver went down and took out that February low and got to 61. And it spent like 2 hours down there and immediately went like a vacuum, right back above the 64 low. In other words, we took out the low, ran the stops, nothing there except buying. We got right back up in the 70s and 80s and back up in the range. So again, if you look at it from that perspective, first off, there's no long-term trend damage done to silver or gold in this break. Okay, it was intermediate issue, and intermediate to short-term technicals broke. The issue, therefore, now is healing up those intermediate to short-term metrics to turn them back positive, so they're back in line with the long-term technicals. Because in any market, you could have a major trend and have counter-trend moves, where all the intermediate stuff goes negative, but the long-term stuff remains positive or remains negative, whichever the case may be. This break is very old now. We've had 6 months of constant selling pressure. And where are we? We're where we were on February 3rd. Okay. So if the bears think they're winning, okay, fine. They keep a lid on it. But on the other hand, every time they sell it off and it gets under 70 and gets a 60 handle on it, go back and look at the charts. How long does it stay there? Okay. Usually hours or days. Okay. And then back above. This is their third and last chance. They either make this one work on the downside or it's over. That's our assessment. Maybe MSA is wrong. Maybe we're going to go like the vast majority of analysts now say, oh gosh, we're going back and basically get on top of the old range, meaning the $50 range. We're going to get back down near there. Okay, do it now or you failed. And we've got numbers not far above the market. We're trading today's 64, 65 area. I won't specify the numbers because they can change day to day, week to week, and we provide those to our subscribers. But it won't take much of a rally out of here. You don't even have to go up $10 or anything like that. Just a handful of dollars, and you're going to start to engage a lot of short-term metrics back into positive trend. In which case we argue, okay, 3 times you're out. Okay, you've had your chance. Kill it or don't kill it. And they've tried 3 times, and all we can see when you look at a silly price chart is somebody's down there in the 60s and buys it every time. And the majority now thinks they're wrong and they're going to go lower. Okay.